A warm welcome to everybody out there. Welcome to our next webinar here at JFD Brokers, and welcome in the name of JFD Brokers as well. It's always a pleasure to have so many people around there listening to those kind of webinars. And today it's time for action. No, that's a little bit of the title of today's webinar. It's Price Action Strategies. So the title is already telling you a little bit of the basic nature of that strategy. We want to have action within the price, and that is what we want to try to catch during those movements, and we want to take part of those movements and finally to get out of them profitable trades into our account. I have to mention the date. It's the 23rd of November 2017, 7 p.m. And my name, Stefan Friedrichowski, as always, for those kind of webinars. You see already my contact here, my email address. Later, we will run through a couple of Excel sheets, and if you want to have those Excel sheets, no problem. Just send me an email exactly to that address here, s.friedrichowski, I know it's a real complicated last name, at jfdbrokers.com. And I will make sure that you get all those Excel sheets, which I will present later during this webinar. The slides of today are already uploaded, so you can download them directly via the GoToWebinar control panel. And there's one question already. Are those webinars recorded? The answer is yes, of course. And you will find those webinars later. Later means always tomorrow. Exactly here. So if you look for the YouTube channel of JFD, just press at Google JFD Brokers YouTube, then you will be automatically directed here to this kind of web page, and you will find the recordings of this webinar as well as all the older ones here. And if you want to go further in detail, there's a button. For me, it's now here in German, but show more. I think it's written in English there. And then you get all the older webinars as well. Always German, English, whatever you like. So you can have access to the recordings as well. So absolutely no problem. But before we start, two things. The one I always show at the very beginning, that is the risk disclaimer, because we talk about trading strategies. Therefore, I have to mention that finally, if you trade always on your own. I think it's self-explaining, but anyhow, I have to mention it every time. And the other thing, last weekend, we have had the WOT, that's a trade fair, World of Trading in Frankfurt, and it was really a great event. And I just want to share with you 3 pictures from that World of Trading. So you can see here a little bit of the boost of JFD Brokers, and you see me telling something about the FDAX seasonal. You might remember that is a webinar we have maybe 5 months ago, how to trade the daily seasonal of the DAX. And you see me here in front of the monitor. It was really a great show there. And 2 other pictures here that, how can I get them? I have made one seminar, and the webinar was about human and machine, who is a better trader. And that will be a topic of next month. So I will do the same talk here in English, done already here on that trade fair. But who is a better trader? The human or the machine? And I think that's an interesting question. You may think already about that, and I want to share with you my thinking about that topic. And that was a talk here as well. And one last picture, just that you see a little bit of how that trade fair went on. Yeah, later they offered some beer, but there have still been some people around still being interested in what I have to share or want to share. And you see how I did it. So you see here's a beer already empty, my computer on top of that. So it was really a nice atmosphere to have that kind of more or less private discussion with street traders, which are always part here of those kind of webinars in the German part as well. So it was really a nice show there. So story went on all the time here until late evening. So, but now back to our price action. So what's about? Of course, when we talk about price action strategies, we have to think about how to define it. We need a definition for price action. You may think, okay, that's easy, but we want to place orders. So we need a little bit more of that kind of definition in order to really say how we want to place our orders. And besides the pure definition, and there are maybe several price action strategies around. Therefore, I do my own definition here. So that we have a common language in order to describe that kind of strategy. I will visualize exactly that kind of order placement in MT4 so that everybody knows exactly what I'm talking about. Before we then start to optimize that kind of strategy, you will see the strategy has 3 degrees of freedom, and I will want to share with you how I do it in Excel on a D1 base. You can go down the road with that kind of strategy to taller timeframes as well. And the Excel sheets are already prepared for doing that as well. I don't do it here today simply because the Excel sheet, yeah, they get a little bit slow, and therefore I decided to show everything on D1. But it's really one of those kind of strategies, and that's not always right that you can go down the road to smaller timeframes. But in this case, I can tell you it's working for smaller timeframes as well. I have already to mention here that we will have some restrictions or limitations within Excel to really develop that kind of strategy, but we can move around a little bit, but as long as we know those limitations, then it's okay. Otherwise, you might have some mistakes, or you will think, hey, that's not correct what we are doing here. And I will show profitable examples for 3 or 2 forex pairs. Then I go for a DAX and gold as well. And I have an invitation for some homework. So you hear me already a little bit smiling, but yeah. So it's just an invitation, nothing else. So how do we define price action? Before we start, just an example already here in MT4, and I want to focus you on exactly this chart here, this part. In this case, it's Euro, Canadian dollar on an M15 time. And you see there's one big candle. This one here, or at least a bigger candle than all the other ones. And here we have exactly such an action. And what we want to do with that kind of price action strategy, we want to take profit exactly out of those kind of movements. That move is exactly what we want to try to catch with our trading strategy. And just have this example on a smaller time frame here. We will go on with higher time frames later, but that is exactly what we try to catch. And you might remember that we have had already one strategy dealing with big movements, and that was the power candle strategy. But that power candle strategy reacts after a big move. So you might remember we realized that whenever we have such huge candles, so-called power candles, then we derived some typical movement after the occurrence of such a big candle. But that is after. The price action strategy now should already gain from exactly those moves. So we want to place our orders in such a way that we profit from those big moves. We don't know when in time they will occur, but because of our placed orders, we are prepared to get that action into our account. So in principle, it's a little bit similar to the open range breakout strategies. So we place two orders, one buy stop, one sell stop, and we place those orders on the base of the open of a candle. Later we will do it on a D1, then everything becomes maybe a little bit more obvious. So we place an order, so we look for the open of a candle, D1, H1, whatever, and within a certain distance, and I put the wording distance here in brackets, but it means in a certain distance we place a buy stop and a sell stop order, and we think about OCO orders in this case. But in principle, the base logic is to have in a certain distance two orders. And now if that movement comes, one of those will be triggered, and hopefully that's the basic understanding here, or the assumption that the move will go further. So not only just hitting our stop order and then going back, no, going triggering the buy stop or the sell stop order and then move on. Like in the example we have had in the euro Canadian dollar example M15. We need a certain distance for that order placement. And a good thing to use here is that we use the ATR, the average true range, which is a measure more or less of the volatility of the market. And we simply use a multiple of that ATR in order to place the two orders, the buy stop and the sell stop order. Think about a chart, you have an ATR, and you say, okay, in a distance of 1 times ATR, I place those two orders. The good thing is of using the ATR is that you always have the overall volatility within your strategy. So if the overall volatility goes up, then those distances in absolute numbers, in bips, for example, would increase. And if there's not that high volatility, the distance becomes smaller in values like bips. The stop loss and take profit we want to place here, we use, again, multiples of that ATR. So especially for the stop loss, we use a multiple of the ATR as well. And then we can use a standard formula like risk reward ratio in order to get our take profit for those trades. So in principle, that kind of strategy has 3 degrees of freedom. As you know, that when I talk about strategies, I always talk about those degrees of freedoms, or you might call them simply parameters, like, yeah, what is a multiple for the order placement? What is a multiple for the stop loss setting? And what is the multiple, the risk reward ratio for setting the take profit? So those are 3 parameters, and mathematically they are simply called degrees of freedom. In principle, you might think about a fourth degree of freedom or parameter here as well, and that is how to define the ATR. So we need an ATR period, but in this case, I simply use fixed periods for specific time frames. When I go here for D1, it will be an ATR of 22, which represents exactly 1 month. So if I would go down, for example, to H1 candles, I would at least go for 24 in order to cover 1 day. But anyhow, that's I use a fixed number because I only want to use the ATR as the overall measure of volatility, but I don't want to use the ATR period as an optimization parameter within that kind of strategy. In practice, it would look like the following. Let's open a new chart that we have one fresh chart without that much additional stuff here. So we go for Euro US dollar, for example, here in this case, or that we have ongoing trades here. Does not mean anything. So let's go for D1 and zoom here a little bit. And what we need else is we need an ATR in order to illustrate what I want to do here with order placement. I always use a fixed minimum because then the ATR is telling me a little bit more. You will see in a minute what I mean. And I go for an ATR period of 22, just representing 1 month. And now I can put this here a little bit further. So now I think we have everything what we want to have here. You see immediately why I use that 0 for the ATR value, because I don't want to think, oh, what a low volatility do we have? Indeed, we have a low volatility right now, but sometimes if you don't use the fixed minimum, then it looks like the volatility goes to 0, but that's not the case. And you see a couple of big candles here. One example, the next example, and so on. And those big candles, there we want to try to catch a little bit out of them into profits into our account. Let me zoom a little bit further here. And that I go, for example, for this huge candle in order to illustrate what I mean with order placement in units of ATR. Let me first, we go for this candle, and this candle has an open, and the open is exactly here. So let's put a horizontal line here, and maybe let's go for blue for that horizontal line. So that's the open at that day, the open of this candle. We know that value. In principle, it would be at midnight, but since I mentioned already, you can go for other time frames, or you can still place those orders later, because normally in the first couple of hours, there will not be huge movements during the first maybe 6 or 8 hours. So here's the open, and let me go delete this. Okay, now it's getting quiet here. So here we are. That's the open, and now we can look for the ATR. The ATR, we can measure the volatility, and the volatility here is about 0.006, just as an example. That's the number we can get here. And now placing those 2 orders might mean, okay, we go for 1 order, maybe here. Let me change the color as well. So let's go for red. Okay, now we have one here, and that distance in this case would be about half 0.5 ATR, just as an example. So that would be the buy stop order, and the sell stop order would be exactly on the other side. So around here. And we have that open. And at that point in time, we would place the two orders. Buy stop here on the red line and the other sell stop on the other red line. Later the day, the buy stop order would have been triggered. So we are long in the market, and now it depends where do we set the stop loss of that order, where's our take profit, and then you will whatever, in this case, more or less for sure, we would have a great trade. Think about we would use as stop loss multiplier the same like the order placement, half ATR for the stop loss. Then our stop loss of that buy stop order would have been exactly that blue line. And even with a risk reward ratio of 3, we would be take profit around here. So of course, great example, exactly what I want to show here. You know that always when somebody is presenting a strategy, everything works. Firsthand, immediately, profit trade, of course. But we don't, we will not have every trade as a winner trade as for every strategy. But in this case, you see exactly what I mean. So our price action strategy means that we, on the base of the open of a candle, and now I say candle because you might go down the time frames to H4, H1 or whatever. So on the base of the open, which is exactly here, the blue line, we place our two orders. If one is hit, then the other one is cancelled. And in this case, it works perfect. So, and you think about other examples, maybe here, the other big candle within that chart, the red one here. So the blue line would have been, in this case, here. And our two red lines would have been one about here and the other one about here. This one would be triggered. Perfect trade. So we try to catch the huge movements whenever they come. And this, whenever they come, we get by our distance order, by setting those orders in a certain distance from the open of a candle. So that's the complete logic. I hope it is well understood now. And just as a reminder, I put into the slides here this picture. You see, it's exactly the same example we have discussed within MT4, but that you still have, as a short reminder, how it should work. In principle, if you download those slides, then this is a perfect illustration of such a trade. So now we want to get that kind of strategy into an Excel sheet in order to check whether it really works. And since we have had already one other strategy, which is a little bit similar, and that is the open range breakout strategy, I started with exactly that kind of Excel sheet. And then I made some changes to that Excel sheet in order to get the price action strategy out of the same Excel sheet, which is always wonderful. By just changing a little bit around, then we come from one strategy to the other one. And the Excel sheets I will show later here, you can have those just by sending me an email. You know the email address, and later I will show it once again. Okay. But I have to remind you that we have some limitations within Excel. That is more a technical limitation, just in order to calculate our trades. And the limitation is here that within one row, we can only really have one action. And that action would be first that our order is triggered, that our buy stop, for example, is active. If that's the case, and within a D1 candle, we can later not distinguish about any stop loss and take profits. That's simply impossible. Especially we don't know whether first stop loss is hit and later take profit or other way around. That's simply impossible if you look to the four numbers of a single candle. So it's a limitation you always have when you deal with those kind of strategies. So the solution for that is simply go down the time frame, because then you can distinguish what event happens first. But here we cannot distinguish between those. Formally, that means that if I present later that Excel sheet, within the first candle, which is always a trigger candle of our order, formally we don't have a stop loss and no take profit. We simply wait for the second candle and then we decide how it goes on. As always, we have that worst case principle. That means if you don't know within the second candle which event, stop loss or take profit, happens first, we always think about stop loss. So we have some worst case principle within the kind of strategy, which is good because in the real life it can only be better. But in this case, for the first candle, formally we don't have a take profit and no stop loss. I just have to remind you about that. There's another limitation that if we go for very small distances between the open and the two orders, then in principle it might be that both are within the Excel sheet are hit. And once again, we don't know which one happens first. And in this case, I decided for the long trade. But anyhow, I will show you how it works and that we still get quite good results out of that. So I talk a lot about the introduction. Let's go into action. That means let's have a look how that Excel sheet works. You know, always it's a lot of numbers, but let me guide you quickly through what we are doing here before we come to exactly those kind of equities. Just an example here for an equity of the price action strategy. Underlying here is Euro Japanese yen on a D1 base, and the unit for our equity is just R, the risk unit R, and nothing else. So maybe you don't know what R means. It's simply the distance between the open of our trade and our stop loss setting is always 1R. And if you want to multiply, if you want to have euros or US dollars within your equity, you have simply to multiply those numbers like 100 with the amount of money you are willing to risk. So then you get all the results in euro. It's exactly like what you're doing when you place a wheel trade. You know, I want to risk, for example, 50 euros. I know the distance in bips of my stop loss, and then you calculate the lot size of your trade. And in this case, I simply do everything directly in R, not calculating any lot sizes, but for the real trading activity, of course, you can do it. So that's how those equity lines are generated. But how are they generated? So I start with something we learned already in our DAX volatility webinar to calculate the ATR. And this starts always with the true range of the candles. Then we do here everything in percent. And finally, we do the averaging, not for the first candles because it's not defined. But for example, here, just that you see what I do, it's just the average of the last 22 candles. So that means we have that ATR 22. That's 1 month about for D1 candles, and that's the reason. So that's the way how we calculate the ATR, because we need that ATR value in order to place our two orders. And those two orders are virtually placed here, but just by calculating where they are. So range max means on the base. Let me click it, then you see exactly what I do. I start with the open of a candle. I look for the ATR of the previous candle because I don't know the final ATR value later the day. So therefore I have to look for the previous ATR value. And then the buy stop order is simply open plus multiple ATR of that candle, and that's the buy stop order. So you see we have 107.7 here, and 1 point above about we have the buy stop order, and about 1 point below, same formula just with a minus, we have that sell stop order. Yeah, and that's all. And now we know where those two orders are, and then we ask here, is the order triggered? Yes or no? And that is simply answered with a 0 and a +1 for the long trade and -1 for the short trade. And then everything else is more or less the same like other Excel sheets before. So whenever an order is triggered, like here, then we calculate where do we set the stop loss, where is our take profit, just by this CRV means risk reward ratio, or Chance Risiko Verhältnis in German. So it's a risk reward ratio. And then we get the two numbers we need, stop loss and take profit. And then same formula like every time, that we calculate everything in R. We don't forget the spreads, and I use here always higher numbers than you might expect, simply because I want to incorporate commissions as well, but not by the real commission values, just by increasing the values for the spread. That's more or less the same like directly calculating a commission for those trades as well. Yeah, and that's all. And then we can add up all our trades and we get our equities. And now back to the degrees of freedom. And let me zoom out here a little bit. You see that I have marked 3 numbers in yellow. One is the multiple for the ATR for our entry levels. Then I have a multiple for the ATR for the stop loss setting, and I have the risk reward ratio for setting the take profit. Just for the start conditions, I do here something else, and that is simply, you see that the values from the order placement and the stop loss are always the same, because I have really hard-coded that those two numbers equal each other, and that makes it a little bit easier just starting that optimization procedure here to get the numbers or to find good numbers for this kind of strategy. So, and now let me put here the picture here, and now we can change the numbers. For example, we can change the distance for the order placement. And you see, of course, the equity changes. We can go this direction, we can go the other direction, and always what you see here is we get an equity for that kind of strategy, and here we get all the key figures we need. Let me remind you that for the first candle, our trade is without stop loss. That means, especially if we go for smaller values of order placement distance, that let me show it you here directly, that we get a couple of trades like minus 1.12 R, 1.37 R, and you think, hey, why should I lose more than 1 R with one trade? Okay, in principle, there might be a gap that would be calculated correctly here as well. But reason here is that within the trigger candle of a trade, we don't have a stop loss. We wait for the next candle, and now we ask, hey, is the stop loss triggered? Yes or no? And if so, then we get a higher loss. So it's once again that kind of limitation we have within Excel, and the only solution is fill in smaller time frames, then you get rid of that kind of topic here. But anyhow, in principle it works. We calculate here higher losses in this case, and that's the reason why the average loss, for example, here in my example, is already higher than 1R, so minus 1.3 in this case. But nevertheless, we get nice equity lines for this kind of strategy. Maybe I go a little bit further up with my multiple for risk reward ratios, my take profit distance. And you see, I always look here for this number of opti, the smaller the better. And if I increase my risk reward ratio a little bit more, it's even getting better. And then finally, it's getting worse on the other hand, once again, at least finally. So you see here, I cannot go for too high values here, but something in between gives me good results for that kind of strategy. And you see already another advantage, as we have had that kind of topic in other development of strategies as well. That is the how robust is our strategy, and that's always looking for the neighborhood, and that's exactly what I'm doing when I press risk reward ratio 2, 2.5, 3, 3.5, and so on, and you see that it's more or less stable. Of course, the equity is not the equity is changing, but it's not dramatically changing into negative, for example. So you see, we get very good results for that kind of strategy. And that's not only for Euro, Japanese yen, although I can tell you that that kind of strategy is good for any underlying which has a tendency to go in one direction a little bit longer. A good example for the opposite would be Euro Swiss franc. That kind of underlying does not move at all, more or less. Maybe shortly up, then going down, then shortly down, going up again. But you don't have at least medium trends. Pairs with Japanese yen, they have a tendency to move in one direction at least a little bit longer, or even DAX values, but there that's a topic we discuss later. Even gold is not that bad. So we can use a selection of underlyings in order to get good values, and you see already here quite well strategy. What you might do is you might use the normal Microsoft Excel And this is here the same example as before, euro, Japanese yen. And then you might use what is called the technique of Solver. Solver is an optimization tool within Excel. You have to activate that in your base settings of Excel. And if you do something like that and press that button, Solver, then you can say, okay, I want to minimize a specific cell by varying other cells, those degrees of freedom, under certain conditions, like higher than 0, smaller than 3, and so on and so forth. And then you can say, okay, please optimize. And then the computer is doing the rest of that job. It always takes time. So you can drink coffee here a lot and waiting for those results. But anyhow, the computer is doing its job and is optimizing your strategy. You can even go for varying multiple cells here, like all of those yellow underlined cells, and then the computer is doing the job of optimization. Just that you know, you can use that kind of technique as well. I mentioned that I want to show you just a few other examples before we go for a long-only strategy as well. Here's an example for euro US dollar. Everything is the same kind of formulas, the same kind of Excel sheet. All you have to do is you have to do filling new price histories within the very beginning here. And you see I have already prepared a time or one column for times. If you go for intraday candles, then you get those that column filled as well. So you put the new prices in here, and then you can figure around what kind of optimization you want to achieve and what kind of results you finally have by going for those three values: the distance for the order placement as a multiple ATR for the entry, and stop loss settings and risk reward ratio. That's euro US dollar, and here we have an example for gold as well. Works well. But finally, I want to show you something. I've done the same exercise here for DAX. It's already behaving not that bad, but I want to try here something else. Since we know from a long history that an index like DAX or other indices like S&P 500 or Dow Jones, whatever, they have a bias. And of course, the bias of indices or even of stock values is simply going north. So they have a preference for increase, as always. And what we can do here is we can try to use that within our strategy as well. Formally, it would mean we don't place a short order. I have done that kind of exercise here within the Excel sheet just with a small trick. And that trick is simply, now my optimization here is ready, so I have to press OK. But anyhow, I go back to the DAX. What I did here is, you see the numbers where I place my short orders. And you see negative values even. So I used a second multiplier for my short order setting, and you see the distance is now 1000 times ATR. Formally, that means a short order is not triggered any time. So simply no short orders within that kind of strategy. Now it's a long only strategy. We would only place the long orders and nothing else. And now it's a little bit better. We have one limitation less now. because if we go for quite small values of ATR multiplier, normally we would not know which order is opened first, the long or the short. Since we don't have a short order, it's always long. And therefore, the Excel sheet it is now a little bit more correct than before. And we have the opportunity to go for smaller distances without that kind of limitation or restriction here. So it works. And you see, we get a quite easy strategy with a couple of trades. It's really thousands of trades on a D1 base. It would be placing one order at the open of a candle. That's all. And in this case, I use the DAX Xetra values, which means I use the DAX values which open at 9 o'clock German time. So it's a really nice strategy. Just looking for the open, then placing my buy stop order on the base of that open value. I use a quite small stop loss distance as well, a higher risk reward ratio, and that's all. If the order is triggered, good. Maybe I will hit my stop loss later, or I wait for my take profit. If a trade is running, I would not place another order the next day. So whenever we have a triggered order, on the next day, we don't place another order. So it's quite easy. And we get very good equities here, maybe a little bit lower risk reward ratios, but anyhow, it works quite perfect. And that you see, it's not always, it's not something like what works every time. If I go for completely other numbers, like other distances, you see I get much less orders because much less trades, so to say, and the equity is not always extremely well. Please don't forget, if you use those Excel sheets and you try other underlyings, always go for the right spread value. If you would use this spreadsheet here and put in data for euro, US dollar, and you would still have a 2 for spread, you will see you don't have any good strategy, because it will simply not work with that spread value for euro, US dollar. So don't forget to change those values. But in this case, it's perfect to work with small distances for order entry, for placing my buy stop order, and then we have that kind of strategy here. And now it's a long only, which is okay for DAX. And we don't have that limitation that we formally don't know which order has been triggered first on a D1 base here. So don't forget about the two limitations or restrictions I have mentioned during the development of those kind of Excel sheets. But that's price action strategy. Whenever a huge movement is coming, we gain exactly from that move. That's all. That's the way, that's the logic behind that strategy. It's a little bit like a dynamical range breakout. You might use other titles or other namings for that kind of strategy, but it's, if a huge action is coming, we will participate, we will gain exactly from that action. That's all. So, that's what we are doing here. Price action strategy. And in a nutshell, price action can be traded well by placing those orders before. And we place those orders on the base of an open of a candle. and we use an ATR for the base volatility. And we use then finally just a multiple of that ATR in order to place our buy stop and sell stop order. And what I have shown here is just for examples for underlyings like euro, US dollar, euro, Japanese yen, DAX, and gold. Yeah, and if you like, you can have those Excel sheets. You can feed them with other underlyings if you like, and find good parameters. Just send me an email if you found something, and yeah, I will collect all those information and share within the next webinar. We definitely will have in December. So, but anyhow, it's a nice strategy for our toolbox. Toolbox is getting bigger and bigger for our different kind of strategies, and I personally hope that you enjoy those kind of informations like this webinar. And see you again soon. It's in about 2 weeks. Just have a look on the JFD event page, and you will see latest the 1st of December the announcement for the next upcoming webinars. See you. And if you want to have those Excel sheets, just send me an email to s.friedrichowski@jfdbrokers.com. And of course, have a nice evening. Bye-bye. Ciao.